CNBC put out a really good article titled Financial Experts Share Their Greatest Money Regrets and They All Have One Thing in Common. And I think this article really explains very well the money regrets that people have in their 30s. So I want to go over the 5 money regrets that CNBC talks about here because, well, I think these are really powerful ones. Let me start with number 1. The first money regret that they talk about is I did not negotiate my first salary. And the reason why this is so powerful is because I don't think many people realize that everything is negotiable. And this includes your salary and everything else. See, like when you go to India, which is where my family's from a state in India called Punjab, you negotiate the price of anything. If you go to the local bazaar, you go to the people on the street selling fruits, and you want to buy apples, you're going to negotiate the price of apples. You negotiate the price of everything over there. Here in America, you barely negotiate the price of anything. Maybe you negotiate the price of your home, but that really just depends on the housing market. Maybe you negotiate the price of a car, but that's really it. But everything is negotiable, and the worst that someone can say is really no. And I want you to remember that because there's a lot of opportunities if you just ask. Now, maybe they'll say no, but at least you tried. And I'll give you an example of this because when I got into law school, I got a scholarship from the university that I got accepted, or I got a handful of scholarships, but the university that I wanted to attend gave me a pretty good scholarship, but it wasn't as good as some of the other universities that had given me scholarships. So when I got the scholarship offer, I said, thank you. And then I also said, I'm really interested in coming to your university. This was Wayne State University, but the scholarship offer that you had given me isn't as good as some of the other universities that I got. And then I told them that some of the other universities gave me scholarships of this size. Is there anything that you can do to help meet or match this scholarship offer? And I sent them the other offer. Now, I wasn't lying when I said this. I actually had the other scholarship offers, which gave me a little bit more leverage here. I sent them the email. I was already accepted into the university. So I didn't think that they were going to revoke my acceptance for trying to ask for more money. I was just trying to see if they'd be willing to give me more money. It took me maybe, 5 minutes, 7 minutes to write that email. And they responded with a yes. And they gave me thousands of dollars more in scholarship from my 5 or 7 minutes that I spent writing that email. Everything is negotiable, and the worst that somebody will say is no. And if they say no, then you can figure out what it will take to actually get the higher salary. But ask. It's okay to ask. It's okay to be looked at like you're weird, but you have to ask. Otherwise, you're never going to get it. Money mistake number 2 is leasing too much car. And this is probably one of the most common money traps and money regrets for people in their 20s and their 30s, which is where you assume that you have to go out and lease or finance a car because everybody else is doing that. And if you're going to finance a car, focus on the monthly payments. And if you can afford the monthly payments, well, you can afford the car. When in reality, you are spending a ton of money on something that isn't making you any money. And when you're trying to build wealth, you need to be focused on making your own self rich first. Right now, the average new car payment in America is $716 a month. That's over $8,500 a year just in your car payment. So let's do the math to see how much this is really costing you. If you spend $8,500 a year on your car payment, and this is assuming no premium gas, no expensive insurance, no expensive maintenance cost, just your car payments. And if you do this for 30 years, because guess what happens is when you finance this car, you're going to drive this car for a few years, and then the financing is going to expire, and then you're going to get a new car and start the payments all over again, and your payments never shrink, they just keep going up. So I'm being generous here, talking about $8,500 a year for 30 years. And if you could have got a return on this money, if you could have got a basic 10% return, that means that your car payments could have been worth $1.5 million worth of wealth. When in reality, what is it going to actually be worth? Well, you're going to be driving a car when you're 65, and maybe it'll be worth $40,000. So instead of having $1.5 million, you just have a car in your driveway. And this is where I want you to focus on making yourself wealthy first. This is going to be painful, but I want you to do is get rid of the car payments. Instead of putting $8,000 down to finance a $50,000 car, take the down payment, the $8,000, and drive an $8,000 car. Yes, you can get an $8,000 good working condition car. Look for a Toyota Corolla, maybe even a Toyota Camry if you can find one, a used but good working condition car, and now you got a car that doesn't need payments. You don't got to have the expensive insurance. You don't have to have the expensive premium gas. You don't have to have the expensive maintenance. And now that $700 that you're not sending to the car company and all the other payments you're not sending to the insurance companies and the maintenance companies, take that money and invest it. It's going to free up a lot of monthly cash flow. Now when you start investing this money, all of a sudden you just got a huge boost to your investment portfolio. As you start to grow this, well, you might start generating some cash flow from your investments. Once you start getting some cash flow from your investments, or once you see your investments start to grow, or as you start to make more money, then you can start upgrading your car. And then you can buy a car with cash that you can afford without having to worry about the price. Because when you don't have to worry about a monthly payment on your car, I can tell you this, you are going to breathe a whole lot easier, because now you don't have to worry about $1,000 a month going towards your car, and $1,000 is your car payment. It's the premium gas, it's the insurance, it's the maintenance, it's the brake repairs, it's the upgrades. All those costs add up, and if you can save all of it and reallocate that money towards your investments, you will be able to build so much more wealth by not even changing that much of your lifestyle, besides just downgrading your car a little bit for a little while. Money mistake number 3 is going all in on tech. And I think this is an important investment lesson, because you see this in pretty much every asset class that's booming. When you see an asset class that's booming, if you're not an experienced investor, even if you are an experienced investor, it's very easy to get caught up in the hype. In the late 1990s, that was putting your money into tech stocks, because all these online companies, if you had the word .com next to it, were able to boom in valuation, and people were making money hand over fist. So it was very attractive to then follow the hype, follow the crowd, and start throwing your money into those .com companies. Well, what happened? Well, 2000 came, 2001 came, and the dot-com bubble burst. And the people that didn't know what they were doing lost money. Even the people that knew what they were doing lost money. So it's very easy to get caught up in the hype, throw your money in, and then not know what's going on. This doesn't mean that tech companies died or the dot-com companies died, but that bubble burst, and then only the good companies survived. Like even Amazon stock fell to under $1 after the dot-com bubble bursting, but Amazon didn't die. But the people that didn't know what they were doing lost a lot of money through it. In the mid and early 2000s, it was the real estate market. People were buying homes with no money down, with subprime credit scores, and then sometimes buying multiple properties because you didn't need any cash to go to the down payment. You could just buy homes and then sell it for huge profits 6 months later. People started to get in. Everyone was telling their cousins and their friends of how much money they're making, and then everybody and their friends and their cousins and their moms started buying real estate. Well, what happened after that? The 2008 dot-com bubble burst, and that party ended. Now, does this mean real estate died? No. The real estate market just changed, and it changed the way that people started investing, and the people that didn't know what they were doing lost a lot of money because of that. In the mid-2010s, what was it? Well, you saw cryptocurrency. The cryptocurrency boom happened. Everybody thought that cryptocurrency was going to be an easy and quick way to get rich, and cryptocurrency went from essentially nothing to about $20,000 a coin. Bitcoin went to $20,000 a coin almost. And then the cryptocurrency market collapsed. And then the people that started chasing the hype and was chasing what everybody else was doing lost a lot of money. And we see this trend happen again and again and again. The asset class changes. You see it happen in the stock market. You see it happen with particular industries in the stock market. You see it happen with real estate. You see it happen with artificial intelligence. You see it happen with blockchain. And this is where now when you chase the next hot thing, you feel like you're making a smart investment decision. You feel like you're going to make a lot of money. You feel like you are making a lot of money, but then bubbles eventually burst. And the people that don't understand what they're doing, they didn't understand what they're buying, were the ones to lose everything. And this is where now your job as a financially smart investor is not to be a chaser. Stop chasing the hype. Don't follow what the media says because, well, the media is in the business of either telling you that everything is going great and nothing can go wrong, or that the world is ending. And when you invest based off of what the media is saying, well, you're going to be very emotional. And if the media has already covered it, well, you've already probably missed that rally. And this is where now your job as an investor is to cut through the noise, avoid all the hypey stuff, avoid all the exciting stuff, and just focus in on the investments that are there that have been proven to build long-term wealth. And this is where now, as you're researching, you don't want to just read all the titles. Read the actual information. Read press releases. Read the data. That way you don't get bogged down with all the emotion. Now, if you don't want to, don't have the time to do that, the next best thing would be to read something like Market Briefs. Market Briefs is my free financial newsletter that I created to help investors, regular investors, stay up to date on what's happening on the top financial news. It's a daily newsletter where my team is breaking down what's happening on things like the housing market, the stock market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market, or you can click the link down in the description below. Money mistake number 4 is unloading inherited stock. Now, I don't know too much about inheritances like this, but I think the whole idea goes down to selling investments. And this could be investments that are given to you or even investments that you buy. Because personally, I'm not a huge fan of selling. I like holding, particularly in places like real estate, because now my goal is to stack cash flow. When I invest in real estate, I know that I can make X number of dollars a month per unit in this property. Let's just go with round numbers, that for every unit, I'm going to make $500 a month. If I buy a single family home, it's going to make me $500 a month. If I buy an apartment complex with 10 units, that's going to make me $500 per month per unit. So that's $5,000 a month in that apartment complex of profit. Sometimes more, sometimes less. I'm just going to stick with round numbers. Now the name of the game is how many units can I stack? How can I stack my cash flow? And sometimes it's very attractive to sell because you see the opportunity to flip this property into a bigger property. And there are certain times where it is useful. I don't say never sell, but I try to avoid selling because my goal is to accumulate a larger portfolio. The times that I've sold are primarily properties that are just big headaches. There was an apartment complex that I bought on a lake. I think it was 16 units or so. And I turned this property around. I built a lot of value in this property. When I bought it, it was completely vacant. It was just not in a good shape. I came in, I turned it around, got tenants in the property, but it was just causing a lot of headaches because the types of tenants that were in this property were just constantly fighting each other and just kept causing a lot of maintenance issues and a lot of management issues that I didn't want to keep dealing with. And I had a lot of new equity in this property, which I just didn't want to keep dealing with the headache. So I sold off the property, realized that equity, and then flipped this money into now a different property. So there are times and places where it will make sense for you to sell. But in general, I'm not a huge fan of selling because I want to own, I want to accumulate, and I want to grow. I want to keep building and buying more because then I can just stack the cash flow. Take the cash flows from one, add on the second. $500 a month, now $1,000 a month, now $2,000 a month, now $4,000 a month, now $8,000 a month, now $10,000 a month. That way you can stack the cash flow. But the only way you can do that is if you keep accumulating and growing. And selling can be attractive, especially when you see the valuation of your assets go up. But if you don't have an investment to buy into, well, now you might be losing a great cash flow producing asset, or you might be losing a good asset with no place to actually put that money. So you have to think, where's that money going to go before you sell? And if you don't have a place to put that money, you definitely want to think twice before you sell. And money mistake number 5 is not considering long-term care. Now, I've seen this firsthand because I've seen the expensive costs of having to take care of elders who need additional nurses, they need additional care. So this is where look into insurances that can help you take care of your parents, or that can help you and your kids when you get older. There's a lot of different insurances that you can look at that can help you as you get older, long-term care types of insurances, something for you to look into or start budgeting towards. That if you start to get older, you know that you're going to need more health concerns, health costs in the future. have the money there to help protect you. And you can also consider looking into getting some life insurance. Personally, I'm not a huge fan of whole life insurance. I like term life insurance because it kind of provides you a bridge as you're building your assets. I don't want to rely on life insurance to take care of my family or me. I want my assets to take care of my family and me, because now they can take care of me when I'm alive. They can take care of me after I'm gone. And every whole life insurance salesperson is going to tell you all the benefits of whole life insurance, but it's really making money for the insurance company and maybe making some money for you. There's a lot of things going on with there. That's why I like term life insurance. It keeps the control in my hands, in my pockets. Now, if you want to learn more about how you can get term life insurance, there's a bunch of companies on the internet. You can check out my affiliate company if you want. I'm a partner with Policygenius. I like them just because of how streamlined they are. You don't have to use them. Find a company that's right for you. But if you want to check out Policygenius, I got my affiliate link down in the description, which means if you use them, we will get compensated, but there's no additional cost to you. So if you have questions about life insurance, check them out. They have teams of people that you can talk to as well. But life insurance is essentially now, if something were to happen to you unexpectedly, your family can at least be compensated with a big check. That way, at least financially, they will be taken care of. The housing market has never been this unaffordable. At least that's according to Business Insider, who just put out an article titled "The Housing Market Has Never Been This Unaffordable for Buyers." And the reason why, according to Business Insider, is because number one, interest rates have skyrocketed so much, and number two, prices for homes have not come down. Let me read you a sentence in this article. It